Here is a common trading scenario. You are bullish on a stock and you take a bullish position. It turns out you were wrong and the stock starts sinking. For the majority of traders, the stock's slide would trigger their stop loss. Unfortunately for them, the stock then takes a U-turn and promptly climbs back to the price level where they initiated the trade. Cue the cursing and the swearing. In this video, I'm going to use options vertical spreads to recreate a similar trade and show you how this trade can actually become profitable despite the stock simply returning to where we started. And we are going to do this with a defined max loss that works better than a stop loss in ensuring we never lose more than the amount we committed. I dare say all traders have experienced a U-turning stock at one point or other in their trading journey. Frustrated with the seeming betrayal, we curse and blame the market when we know full well the responsibility lies with nobody else but us. I say that because for every trade that we got stopped out with losses, there are other traders who profit from the same trade. Both traders started with the same bullish assumption, the same loss management mindset, but very different trade strategies. Let's explore this situation using actual market data that happened in June of 2020. Following a large gap down at the market open of 10th of June, the trader takes a bullish bet on SPY in the morning. Here are three different strategies that led to different outcomes. Strategy A. The trader buys SPY stock with a stop loss set at $500. Strategy B. The trader buys SPY stock, but this time with no stop loss whatsoever. Strategy C. The trader opens a vertical spread, specifically a bull call spread, with SPY options with a max loss of $556 and a max profit at $444. Unfortunately for the trader, 10th of June ended up as one of the most bearish days of the year. Let's look at the positions in each of the different strategies by the end of the day. Strategy A was stopped out with a $500 loss, which might be for the best at this point because strategy B is down $914 without the stop loss and it's still in position, meaning strategy B could possibly lose even more if the SPY continues to crater. Strategy C is down only $214, which is surprisingly little. The implied volatility of the long 305 call option surges with market fear, which helps alleviate some of the losses. The short 315 call option, on the other hand, is profitable as this leg is bearish. Out of a possible $280 of premium in the short call, $151.50 has already been collected. Here's where strategy C and option strategies in general really excel in terms of the possible strategic choices available to traders. Since the short call option is already profitable, the trader can make a choice. The trader could leave the vertical spread untouched and keep the same maximum loss and profits. But the real beauty here is the ability to take profit on the short call, also known as morphing the vertical spread. What this means is that the trader would morph the vertical spread into a plain vanilla long call strategy by pocketing the $151.50 premium gained so far in the short call. In return, the trader gives up the remaining $128.50 that could have been collected. This would mean that the new maximum loss has increased to $684.50, but in return, the trader gains unlimited profits to the upside if the stock reverses. Now, a word of warning here. Strategy C is a bull call spread, which means the bullish leg is the long call option and the bearish leg is the short call option. There is an analogous vertical spread known as the bull put spread, which is essentially identical in the risk profile, but this morphing will not work on the bull put spread. The long and short put options are placed at opposite sides of the vertical spread. Executing strategy C on a bull put spread could expose the trader to unlimited losses instead of defined losses. Always check the resulting risk profile before executing the strategy. Alright, back to our market scenario. Fast forward 4 days from that precipitous market drop and the SPY has recovered to the opening price of our trade. Let's evaluate the three strategies now. Strategy A was stopped out earlier with $500 loss and missed out on the recovery. Strategy B recovered the initial losses and is now at break-even. Strategy C, on the other hand, is at $121 profit after taking profit on the short call, while the long call has recovered its losses. What strategy C effectively did was to make both a bearish and bullish trade at the same time, even though that was not the intention of the original trade. The choice is there for strategy C to take because of the way the vertical spread consists of two options legs working in tandem, one bearish and one bullish. You could argue that strategy A can re-enter the trade at the same time that strategy C closed the short leg. and that the winnings is a matter of timing and not strategy. But I disagree. The critical difference here is the trade-off in risk. Re-entering using strategy A would mean setting another $500 stop loss, which effectively means it can be treated as a separate trade position, managed independently from the initial losing trade. Strategy C, on the other hand, had a much smaller increase in risk, $128.50. And the resulting position is completely different from the original vertical spread. It is a morphed trade that can only be executed using options. So here's a short summary of the vertical spread's advantage in a directional trade. 1. It has defined loss limits. 2. It remains in position despite big moves in the other direction. 3. Able to take profits on the short option in exchange for an increase in the maximum loss. And 4. Becomes a profitable trade after morphing if the stock U-turns back to starting price. One important factor that makes strategy C much more favorable than strategy A is the absence of stop loss triggers. In my opinion, stop losses are a big disadvantage compared to using loss limiters with options strategies. In fact, I'm going to be dedicating a video to comparing traditional stop losses and the use of option strategies to limit losses. So look out for that video coming very soon. In the meantime, if you are new to options trading, I strongly encourage you to do your research and learn more about options trading strategies and the plethora of strategic choices available to you to take your trading skills to the next level. Till my next video, take care and see you again soon.